it out pretty well, Senator. It is not about the bookends or the more urbanized areas. It is about the ability to get a stable revenue source, which happens in, as we look at it from our perspective in the plan in 2023. You start 2022, 2023. At that point, we believe that we can, in fact, sell future revenues at a discount anywhere from 8, 11, 14%, showing about $10.1 billion there. And that has to do with the finalization of the iOS and the operation thereof. So it's not really about, as you characterize it, the bookends or the urban areas. It's about having an operating segment that generates sufficient ridership such that you can sell those future revenues. And when you look at the plan as you have, what happens at that stage is you're looking at an approximate, on a cash flow basis, a net operating cash flow, or net operating cash flow margin, if you would, of approximately 48%, which in turn allows someone from the private sector to be able to, in fact, calculate exactly what that's worth to them, predicated on two things. One, on a discount rate, which is how they will ultimately make the decision in pricing, but predicated on how much not only is that worth, but what they in turn can run it more efficiently for to even make more money.
So then, in order to, if you were to try to probe the market a bit and try to find out who might be interested in those options, you would have to be how much further along, or what would you have to do?
Are you asking, Senator, could we get it sooner?
Initially I was thinking that if it was an investment opportunity on like two ends, and then you might be able to go out sooner and find out how you could raise some private money or have private partnerships. In this case, since it's predicated on 2023, then what I guess what I'm trying to ask is, what would the soonest that you could find out or probe investor interest in a reliable way?
Well, the issue is reliable, right? Because everyone today who assumes that this investment will be made has an interest. Now, since 2004, if my memory suits me, there have been 16 such investments made in the private sector, ranging from several billion to $14 billion. There's no doubt there is a market. I mean, if you can sell future revenues of an Elton John concert, you can sell future revenues of a railroad line. The fact is that there is an interest once there is a clearer understanding on behalf of the investor that you have, in fact, a stabilized ridership that will generate, in fact, the kind of margin I just said our plan projects.
So stabilizing ridership probably couldn't happen until...
Well, as we said, we plan for it in 2023.
Okay, thank you.
You're welcome.
Let me just ask a question. One of the concerns about this is that as the LAO and the peer review group have both suggested, it seems to me that the risk is on the taxpayers of California to spend $13.5 billion, and if it's a failure, we're stuck with the loss, and if it's a success, we're handing our success that we paid for off to somebody else. As a business proposition, that doesn't sound very appealing, frankly. It sounds like the risk is on us and the upside is on somebody else. Now, what I thought I heard you say earlier is that in some models, the hope would be that there'd be the ability to have a successful enough project that we could actually recoup some of our initial investment, and or that if we had a successful enough model, we would be able to then generate private investment for the remainder so that the taxpayer wouldn't be on the hook. Am I understanding your model correctly?
I would refer you to the plan, Senator. We have run in this plan 60-year cash flows. in order to take the cash flows out a particular time frame, since these are 100-year assets. And to address your question specifically, the state can make up its mind which way it would like to go. If we hit our numbers, and on the full phase one, blended, not full phase one, but I'm sorry, the full blended phase, we would, in 43 years from the beginning of construction, we would receive in free cash flow $68 billion. We would, in fact, repay these monies. Now, we can have a discussion about what the actual indexing values of those dollars are. I'm sure my friends at the LAO would want to see that study, but we can do that. But the cash flows are there. The question then becomes how you utilize those cash flows. In 12 of the 13 operations around the world, and I don't want to talk about the 13th one because that's China, and I'm not going to try and pretend I understand their numbers. But if you look at the other 12, what appears to be the case is that they generate enough money on a net operating cash basis to pay upwards of 13 to 25%, that's a little high, I'm sorry, 13 to 20% of future construction. So we could do that, or we could do, as we have in the plan, we could sell the future revenues at what we think is a reasonable discount in order that we can use those monies to reinvest in the next segment. It's a matter, I think, Senator, of how you decide at that time how you would like to utilize those funds.
All of this being predicated on the eventual rightness of the revenue and ridership projections.
Yes, or let me put it to you another way. It would depend on whether or not all of the sensitivity analysis we have done to take those bands and move them closer and closer together and then haircut them to the point that if you take a look at 2026 and you take a 35% increase in expenses and you reduce revenues by 35%, which is, at my last count, I'm pretty old, but I think that's a 70% swing, we are still $312 million above break even. I think it would be very hard. We can talk about this model forever, but if you want to take a look at the sensitivities and the way we would make an investment, you can't find another major project where ridership has been off that much. And it really isn't ridership. It's really a matter of whether the ridership and the revenues therefore generated and the expenses as they are managed that give you that number.
Yeah. Senator Solnit, anything on this?